The last 3 years in the stock market have been eventful, to put it lightly. 2020 was the year of a short, sharp crash of about 30% in the S&P 500, which was followed by a monster recovery, which caused the index to finish the year up 18.4%. In 2021, the recovery continued and eventually transformed into rampant speculation. It caused the birth of meme stocks like GameStop and AMC, and more conservative value investor types who were wary of overpaying for businesses. People like Warren Buffett were told that they had lost it. 2022 was the year where the air steadily deflated out of that bubble of speculation that was created in 2021. Cathie Wood's flagship ARK ETF finished the year down 80% from its 2021 highs, and value investors who owned stocks that actually produced cash flow pretty much outperformed right across the board. That now brings us to 2023, where Warren Buffett has no longer lost it, and in fact his company Berkshire Hathaway has now outperformed the S&P 500 over 1 year, 3 years, 5 years, 10 years, and basically as far back as you want to go now at this point. And it's also a period of time where billionaire value investor Cliff Asness of AQR believes the bubble has not yet popped. In this video, let's take a look at some of the latest data on the value spread from Cliff Asness. And although broad market valuations don't directly impact my personal investment strategy, this type of information does give us a really good idea of where we are more likely to find undervalued stocks in the market. As they say, it's always best to fish where the fish are. Now this graph here from Cliff Asness shows us the current state of the global value spread. Now the value spread simply shows us the gap between the most expensive stocks in the market and the cheapest stocks in the market. And this is something that Cliff Asness has tracked for many years at this point. I've covered it here on the channel multiple times. And even after a massive kind of drop in many very speculative stocks throughout 2022, the value spread, or the gap between the cheapest stocks in the market and the most expensive stocks in the market, remains very, very wide. Throughout 2021 and 2022, we were anywhere from the 98th to the 100th percentile in terms of the value spread being as wide as it had ever been. And even after quite a big drop in many very expensive and speculative stocks and some pretty good performance in cheaper value type stocks, we're still in the 94th percentile. So the implication here is there's still potentially quite a long way to go in terms of closing the gap between those two different baskets of stocks, the ones that tend to be the really high quality or the really speculative companies that people pay very high fancy prices for, and the potentially lower quality and more slow growth type companies. And this isn't the first time that the value spread has been super blown out. The other really notable period of time is in the year 2000. That was, of course, the dot-com bubble, and following 2000, when the value spread compressed and really high-flying technology stocks at that time did quite poorly, and more cash flow generative, cheaper companies did really well. That was the birth of a lot of really well-known value investors today. People like Monish Pabrai, Guy Spear, Michael Burry, David Einhorn. They all really gained a lot of their reputation from those years of great performance in the early 2000s, where they were buying really cheap, surprisingly good quality companies hand over fist as the dot-com bubble kind of imploded. But we've also had periods of time where the value spread has been very narrow. The gap between the cheapest and the most expensive stocks has been next to nothing. We're talking about a period of time like 2014 or 2015, where companies like Microsoft, for example, were trading at less than 10 times earnings after you accounted for the big pile of cash that they had. This is right around the time where Warren Buffett, for example, was loading the boat on Apple, and you really did not have to pay very expensive prices at all to get into some of these high quality, faster growing companies. And Cliff Asness really isn't alone here with some of his comparisons to the period around the dot-com bubble. Michael Burry has been tweeting over the past several months with a lot of comparisons to that period of time. So just to look at a couple of tweets from Burry. The first one here, he said, "Another feeling I'm getting is mid to late 2000. Free cash flow totally on sale and ignored, while former momentum stocks that are coming down but not far enough and darling and quote better businesses still had a ways to fall. Value was about to take off for years, despite more crash on the way." So just like the data from Cliff Asness kind of suggests in the value spread here, Michael Burry kind of agrees that really cash flow generative stable companies, even if they are slightly slower growing, are just significantly cheaper than a lot of quote better businesses, businesses with the high return on equity and the high growth that have done so well for the past 5 or so years. And despite his expectation here that he thinks a lot of these quote better businesses still have a long way to fall, he thinks that, many of these free cash flow generative cheaper companies can do quite well. Another tweet here from Burry that kind of reinforces this message that he's trying to get out there is low price to cash flow businesses are different today versus 2000 because they will buy back stock, buy back debt at a discount, and in general manage capital structure better. Makes them statistical values, math problems that more or less must work out. And although when we look at Michael Burry's portfolio, there's a lot of turnover every quarter and the portfolio is kind of constantly changing, we've seen a pretty common theme over these past couple of quarters of companies that do generate a lot of free cash flow, that are doing share buybacks, and Burry clearly believes that just mathematically, that can only go on for so long, that these companies remain cheap and buy back shares, and it is really a math problem that just has to work out in terms of the stocks eventually going up, at least in the mind of Michael Burry. And final tweet here from Burry is that companies that are heavily leveraged but have the cash flow and termed out debt have options today, including reducing their debt loads at a significant discount brought on by higher rates. But as Graham said, that's of course Ben Graham, the author of The Intelligent Investor, but as Graham said, in such a case, better off buying the stock. Now, this is a really important point that I haven't seen a lot of people cover here on YouTube, is that with recent increases in interest rates, companies really do have quite a few options, particularly if they generate cash flow and they have recently issued some debt. Let's take a look at this bond from Berkshire Hathaway, for example, which was issued in early 2021. With this particular bond, Berkshire Hathaway was able to sell $750 million of the bond, so effectively they took on $750 million of debt. The terms on that debt was a 2.5% coupon or 2.5% interest rate, and the maturity date was way out into the future in January 2051. So Berkshire would pay 2.5% interest on this bond until 2051, at which point they would have to repay the entire $750 million in one big lump sum. Now, interest rates today, if you were to issue a bond, are clearly going to be a lot higher than 2.5%, and that means that bond investors have kind of sold down or marked down the price at which these bonds trade in the market. And in the case of this specific bond from Berkshire, these bonds now trade at $67.35 versus a par value of about $100. So they trade at effectively 67 cents on the dollar. So Berkshire basically have a couple of different options here with this bond. Number one, they can continue borrowing the money through till 2051 and pay only a 2.5% interest rate on the bond. Or secondly, if they want to, they could actually repurchase this debt at about 67 cents on the dollar. So what that means is, although they have $750 million in debt on their balance sheet because of issuing this bond, they could take $470 million of cash and repurchase that debt entirely, which really creates a lot of equity on the balance sheet because they're able to buy that debt back so cheaply. Like Burry's getting at here, companies like Berkshire that issued a lot of low interest rate debt when they had the opportunity to do so, these companies do really have a lot of options in terms of their capital allocation decisions. Now, one of the common things that comes up when we talk about the value spread and the gap between cheap stocks and expensive stocks in the market is that surely the most expensive stocks in the market as a general basket are higher quality. Presumably they grow faster, they earn a higher return on invested invested capital, and generally speaking, that is the case. However, the spread is now at a point where it's so wide that the extra growth that these companies get is really no longer probably justified, at least as a basket. Of course, you can pick out individual companies that have a high PE ratio, for example, that will likely do very well because they will grow, very, very fast. And you can also pick out really cheap companies that'll probably do quite poorly. But as a general basket, over the long term, these kind of two buckets of cheap and expensive stocks have had growth rates that are different by about 4%. So the forecast earnings per share growth over the next few years typically is about 4% greater in the expensive basket versus the cheap basket. However, if we look at that data today, the expensive stocks are only expected to grow about 2% per year faster in terms of their underlying earnings per share than the cheap basket, which means that even though you are paying up a little bit and you are getting more growth, that growth really does not justify the big price that you're having to pay to get into those higher quality companies. So those are a few data points that I thought would be really interesting to share in terms of where we kind of stand with the general market conditions and general kind of opportunity set in the stock market right now. Like I said at the start of the video, these kind of macro overall market kind of things don't really directly influence my personal investment decisions. I really am just looking for individual companies that I think I can understand and that are undervalued. They may be really high growth or they may be really low growth, but this kind of data does point us probably in the right direction, and it tells us that if we are hunting for undervalued stock market investments, potentially hunting in those lower growth, lower kind of PE ratio and so on stocks is probably not a bad place to start. And as Michael Burry suggests here, a lot of those companies that have businesses with strong cash flow generation and that actually have a good amount of debt have a lot more options than they have done in the past. So that's all I've got for today's video. If you did enjoy it, be sure to subscribe so that you can see future content as soon as it goes live, and I will see you in the next video. Cheers.